Somewhere in a data center this week, an algorithm registered 57,000 and started selling dollars. That is not a metaphor. That is Thursday morning, July 2nd at 8:30 Eastern, when the Bureau of Labor Statistics released the June non-farm payrolls report, and the number came in at 57,000. Not the 110,000 economists had forecast, not even close, the weakest reading in 4 months, arriving in a summer when every other indicator had suggested the American labor market was merely cooling rather than cracking. Unemployment, oddly, fell to 4.2% because workers left the labor force faster than jobs disappeared, which is its own kind of unsettling arithmetic. Wage growth ticked up to 3.5% year over year, and gold, which had spent the entire second quarter of 2026 in a slide so severe it was drawing comparisons to 2013, woke up. It is worth sitting with how bad that slide had been, because the recovery only makes sense against it. Gold closed the second quarter down roughly 14%, its steepest quarterly decline since 2013, the year the metal fell 28%, and an entire generation of gold bulls learned the word capitulation. Silver had been dragged down alongside it, touching lows not seen in 7 months. The proximate cause was simple and almost boringly rational. Markets had priced in better than a 60% probability that the Federal Reserve, under its new chair, Kevin Warsh, would raise interest rates in September. When the risk-free rate on a Treasury bill climbs, every ounce of silver sitting in a vault, earning nothing, has to justify its existence against that yield. For 3 months, it mostly couldn't. Then came Tuesday. At the ECB's annual forum in Sintra, Portugal, the closest thing central banking has to a family reunion, Warsh said that inflation expectations had eased over the past month, and that there was, in his words, no particular urgency to raise rates. He did not abandon the Fed's inflation-fighting posture. He reiterated the commitment to price stability in the same breath. But nuance, in a market that had spent 3 months pricing uncertainty, reads as news. Silver moved above $59 an ounce. It was a small thing. It turned out to be a preview. Because Wednesday brought the ADP report showing private hiring had slowed more than expected, and Thursday brought the number that mattered, 57,000. Rate hike odds for September, which had sat above 60% for most of the quarter, fell to somewhere between 50 and 54%, depending on which desk's model you trust. Gold broke above $4,100 an ounce Thursday morning, rebounding from an 8-month low. By Friday, today, July 3rd, gold was trading near $4,183, up close to 1.5% on the day. Silver had climbed above $61. Both metals were on pace for their first weekly gains since May. Gold up roughly 2%, silver up roughly 5%, outperforming as it typically does when the monetary narrative turns. There is a second story running underneath the jobs number, and it involves a body of water 8,000 miles away. The Strait of Hormuz, through which a fifth of the world's oil transits, had been a live risk for much of the spring, amid tension between the United States and Iran. This week brought signs of a thaw, commercial shipping resuming, indirect talks showing progress, oil prices sliding towards $68 a barrel. Lower oil prices eased the inflation pressure that had been feeding the rate hike case in the first place. It is a small mercy, and a fragile one, but it is part of why this week's metals rally has legs beyond a single data print. None of this, on its own, tells you what to do with your money, and no one selling you certainty about that deserves your trust. What it tells you is that a market priced almost entirely for hawkish resolve just got a data point suggesting the resolve may not need to be tested as hard as everyone assumed. That is not a green light, it is a recalculation. And recalculations in a market that had gone from euphoric, silver hit an all-time high near $122 back in January, to nearly despondent in the space of 5 months, tend to move fast in both directions. Here's what deserves your attention before we go further, because the second half of this story is not about a single jobs report at all. It's about something that doesn't reverse on a Friday morning, something that has been building quietly under the surface of every headline about rate hikes and Fed chairs for 6 straight years. And if you've stayed with me this far, you should stay for that part too, because it changes how you read everything I've just told you. If this kind of grounded, unhurried breakdown is useful to you, this is exactly the kind of channel worth subscribing to, because these situations develop over weeks, not single sessions, and I'll be tracking every turn of it. The jobs number explains Thursday. It does not explain why gold, even at its worst point this quarter, never traded below $4,000, a level that has held as a kind of psychological and structural floor through every wave of hawkish repricing since the spring. It does not explain why central banks, in a World Gold Council survey conducted this year, overwhelmingly said they expect to keep adding to their gold reserves, regardless of what any single Fed meeting produces. And it does not explain silver at all, because silver's story was never primarily about interest rates in the first place. Silver has a supply problem, and supply problems do not check the economic calendar. That is where we turn next. The gold-silver ratio sat at roughly 68.6 to 1 as this week closed, meaning it took about 69 ounces of silver to buy 1 ounce of gold. The 50-year historical average for that ratio runs closer to 60 or 65 to 1. At its most extreme point this year, during a spike in Middle East tension, the ratio stretched into the mid-80s, among the widest readings of the modern era. And in January, at silver's all-time high near $122, the ratio had compressed all the way down to roughly 50 to 1, meaning silver, for a brief window, was extraordinarily expensive relative to gold by historical standards, before the second quarter's sell-off reversed that entirely. Ratios like this are Rorschach tests for anyone with a position, and I'd rather hand you the number than the interpretation. What I'll say plainly is that every time in the last 5 decades this ratio has stretched meaningfully above its long-run average, the eventual correction has tended to come disproportionately from silver's side. Silver rising faster than gold, rather than gold falling to meet it. That pattern held across the stagflation of the late 1970s, the 2008 financial crisis, and the 2020 pandemic shock. It is not a law of physics. It is a tendency, observed across very different monetary regimes, and tendencies can break. What makes this particular moment different from those prior cycles is what sits underneath the price action entirely, the physical market, as distinct from the paper market where futures and rate expectations do their daily business. The Silver Institute, working with the research firm Metals Focus, published its World Silver Survey in April of this year and reported that 2026 will mark the 6th consecutive year of a global silver supply deficit, demand outstripping mine production and recycling combined. Estimates of the size of that shortfall have varied across the Institute's own updates through the year, ranging from roughly 46 million ounces in the initial spring forecast to considerably larger figures in subsequent revisions. But the direction has been consistent: 6 straight years in deficit, with cumulative drawdowns from above-ground stockpiles since 2021 now measured in the hundreds of millions of ounces, a meaningful fraction of an entire year's global mine output, simply consumed and not replaced. That deficit persists for a reason that has nothing to do with Kevin Warsh or the September FOMC meeting. More than half of all silver demand is industrial: electronics, solar photovoltaic cells, electric vehicles, and increasingly, the build-out of AI data centers and advanced semiconductor manufacturing. That demand is largely inelastic in the short run. A hyperscaler building a data center does not pause construction because rate hike odds moved from 60 to 66%. A solar manufacturer with a photovoltaic cell design already in production does not redesign its supply chain because the ADP report came in soft. Mine supply, meanwhile, is slow and inflexible in the other direction. Most silver is produced as a byproduct of gold, copper, and zinc mining, meaning higher silver prices alone don't reliably summon more silver into existence. New primary mine supply can take the better part of a decade to bring online. So you have 2 clocks running at different speeds, and this week is a useful illustration of both. The fast clock is monetary. It moves on jobs reports, Fed chair remarks in Sintra, oil prices tied to shipping lanes in the Persian Gulf. That clock just ticked in silver's favor, meaningfully, in the space of about 48 hours. The slow clock is structural: mine output, industrial consumption, above-ground inventory levels, and it has been ticking in the same direction, deficit after deficit, for 6 years running, almost entirely independent of what any Fed chair says in any given week. I want to be honest about the part of this that should give any silver holder real pause, because a channel that only tells you the bullish half of a story isn't giving you analysis, it's giving you a pitch. The structural deficit is real, but it has coexisted with a 35% decline in silver's price from its January peak. Structural tightness and falling prices are not contradictory. They can and did run side by side for months because paper market positioning, driven by rate expectations and dollar strength, can overwhelm physical fundamentals for a long stretch before the two reconnect. If the physical deficit were a guaranteed floor under the price, silver would never have fallen from $122 to $58 in the first place. It did. The deficit didn't stop it. The honest way to hold both of these facts is this: the structural deficit does not tell you where silver trades next week or even next quarter. Paper markets can diverge from physical reality for longer than most people expect, and they can diverge further before they resolve. What the deficit does tell you is something about the character of any decline that does happen, that it is occurring inside a market genuinely short of metal, drawing down inventories that were finite to begin with, rather than a market with abundant physical supply simply waiting to be sold. Those are structurally different kinds of bear markets, even when the price charts look identical on a screen. That distinction between a monetary correction happening inside a structural deficit versus one happening inside genuine oversupply is the single most useful lens for reading this week's bounce, and it's the lens most of the coverage racing to explain Thursday's jobs number entirely skipped past, which is exactly why it's worth unpacking what comes next. Institutional forecasting on precious metals is, by nature, a study in disagreement dressed up as consensus. J.P. Morgan has projected gold reaching $6,000 an ounce by the end of 2026. Other institutional models have run considerably more conservative, clustering closer to $4,700 for the near term. Reuters' most recent analyst poll put silver's 2026 average forecast near $79 to $81 an ounce, revised sharply upward from a $50 forecast made as recently as last October. Itself a reminder of how quickly institutional forecasts have had to chase this market's actual behavior rather than lead it. None of these numbers should be mistaken for predictions in the scientific sense. They are informed guesses from people whose job is to make informed guesses, revised every quarter as reality corrects them, and the honest takeaway is the range itself. Serious institutions are positioned across a wide band above current prices, with essentially none of the major desks forecasting a return to $50 gold or single-digit silver. The more interesting data point isn't a price target at all. It's what central banks are actually doing with their own reserves, because central banks are, almost definitionally, the least sentiment-driven buyers in this market. The World Gold Council's 2026 survey of central bank reserve managers found an overwhelming majority, cited at roughly 89%, expecting global gold reserves to grow over the next year, with a substantial share saying their own institutions' holdings would increase. That is a different kind of signal than a retail rally or a hedge fund's September positioning. Sovereign buyers operate on multi-year horizons and don't typically reverse course because of one payroll's report, hot or cold. Their accumulation has continued through gold's worst quarter since 2013, which is itself worth noting. The buyer least concerned with this week's headlines never stopped buying during the very stretch when everyone else was selling. So where does that leave the next several weeks, practically speaking? The July FOMC meeting is now roughly a month away, and this week's data has genuinely narrowed the range of plausible outcomes. A July or September hike is no longer the base case it was 10 days ago. But it has not eliminated the possibility, and a single strong jobs report in either July or August could reverse a meaningful part of this week's move just as quickly as this week's soft report produced it. Watch whether gold holds above the $4,000 level on any renewed hawkish repricing. That level has functioned as a genuine floor through multiple waves of pressure this year, and whether it holds again will tell you more than any single week's headline. Watch the Strait of Hormuz situation through the coming weeks, because a reversal in shipping or a resumption of tension would push oil back up and hand the inflation argument back to the hawks almost overnight. And watch silver's relationship to that gold-silver ratio. A continued compression back toward the 60s, even amid volatility, would be consistent with the structural deficit reasserting itself against the monetary suppression that dominated the second quarter. What this week actually demonstrated, stripped of the noise, is that this market was never as one-directional as the second quarter's chart made it look. A single jobs report does not erase a 6-year structural deficit, and a 6-year structural deficit does not guarantee protection against a single hot jobs report either. Both of those things are true simultaneously, and anyone telling you this is simple in either direction, guaranteed upside because of the deficit or guaranteed downside because of rate policy, is selling you certainty the market itself does not have. That is, in the end, the most useful thing this week can teach a silver or gold holder. Not a signal to buy or sell, but a clearer picture of the two forces actually in tension. A fast-moving monetary clock that just ticked favorably, and a slow-moving structural clock that has been ticking in the same direction for 6 years regardless of who chairs the Fed. Understanding which clock is driving a given week's price action is worth more than any single forecast, because it tells you what kind of move you're actually looking at and what would have to change to reverse it. If this kind of breakdown was useful to you, I'd genuinely like to know what part of it landed. The jobs data, the deficit numbers, the ratio history. Drop a comment and tell me, because it shapes what I dig into next. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions, so you can make your own decisions with your own money and your own risk in.